And welcome to episode number 22 of Daily Market Mastery with me, Christian Rauchenwald. I'm a popular investor in eToro, and in this series, we are using Elliott Wave Theory to try to work out where certain stocks or indices are likely to move to basically find new potential profitable positions to enter and manage my portfolio. Now, as always, or if you're new to this series, make sure to check out episode number 1. It's a little longer, but it covers the basics of Elliott Wave Theory. Additionally, obviously, check out the links in the description down below that share or that contain all the tools that I'm using, as well as a link where you can read the book online for free if you don't want to spend money on a physical copy. And you can also find the link to the one-page cheat sheet that's there as a PDF as a free download that summarizes all the rules and guidelines for the different wave patterns. Now, before we jump into it, as always, usual disclaimer, everything that I share in this live stream / video, if you're watching it later, is my personal opinion and in no way financial advice or financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. So I'm doing my best here to manage my portfolio successfully, but it doesn't mean that the decisions that I make are always right, correct, or whatever, or that they're right for you. So you can, use the information that you get from the stream, but then obviously maybe use additional information or whatever, but always make your own decisions. Don't jump into a position because you heard me say, I believe it will go somewhere. There are no guarantees, and that's also something that you can take away from looking at my portfolio, that as you can see, year-to-date return minus 17%, 2-year return 62%, and if we look further back, you can see that while long-term I've outperformed the markets, my decisions sometimes cause things like minus 11, minus 14, minus 10. So there's not always a guarantee that I'm right, which means you should not just use what you're seeing here, but you should obviously make your own decisions. If you don't want to deal with any of that or so, you can also use the link in the description, or it's pinned in the chat as well. So this one here, to either copy my portfolio or to check out any of the other popular investors on eToro and find one that suits your risk appetite and investment horizon, and then just copy that person so you don't have to make the decisions and work out what to invest in. However, that obviously also comes with specific risks. Now, what else is there to say? As usual, we're going to pick something from the economic calendar to look at today. And then on Monday, we're going to, again, have another summary of like how our positions are going so far. And so with that, we jump to the economic calendar. I'm already looking at June because in May, we pretty much already looked at everything that has earnings. I think PayPal we might have skipped or so, I'm not sure, but I think the rest we covered. So we're going to jump into June. And in June, we already looked at GameStop. There's a separate episode for that. We looked at NEO yesterday. The rest are here not earning. Can I actually hide stuff here? No, I cannot hide stuff. So I only want to see the earnings. The next thing would be Micron Technology Inc., MU. Let's see if we can find that in our software here. Motive Wave, MU, search Micron Technology. Yep, there we go. And then as usual, 2-day chart, inherit from this, get rid of the volume if there's a volume indicator. I don't know. I have to figure out where I can disable that thing permanently. And then double check, first switch here actually to monthly. So we have history since 2010 roughly. And then the first thing we do, double check, and we go to tradingview.com. That's also linked in the description down below. And we add that here, and we look at the chart here simply to make sure that we have all the history. And as we can see, we do not. So again, for some reason, we do not have the full history, which makes a huge difference in this case. We have history basically, if we look here from 2011, and if we look here, we can see 2011 would be, where's 11? So we have history from roughly here, so this part here, without all of that, which is really important when we try to figure out the overall direction that the stock is moving. So we start basically here, and the first thing that we would do here, and it's super easy, like it's really a perfect stock, it would be 1, 2, and then we are currently in wave 3, 4, 5, which is already great for us because we're in a third wave, and if we figure out where in that third wave, we can actually find a decent entry and long-term profitability. Now, we can also confirm that super easy because it's super obvious that this here is either here or here, probably here. That one here, 1, 2, then we have a strong third wave followed by a corrective pattern, which probably finishes up here, but could finish there. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Now I'm gonna put it here, so we're not gonna go and confirm that on a lower degree, but basically that's divided like this. This here could be a combination of a corrective pattern, since this one is a simple corrective pattern, ABC. So this one could be W, I don't know, yeah, W, X, Y, blah, 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 yeah. So yeah, not gonna bother to confirm that. The important part, however, is we only have data from 2011, which means we missed that first part here, and which means like here it's most likely up 1, 2, and then we would have a breakout here. So actually, let's get rid of that real quick, and let's try to use Kennedy channeling technique to figure out where we are here. And let's first fix that point 2 that belongs here. So if that is our starting point here, which it is, and that here would be our 1, 2, then we're going to have a problem with Kennedy channeling technique because we don't have a clear breakout. Yeah. On the other hand, if we zoom in here, even without looking closer, we can identify something like 1, 2, 3, 4, 5, or 5 till here. A, B, C, that would then need to be a flat corrective pattern. And then we would have starting point here, which would be 1, 2, 3, 4, 5, or with an extended fifth wave here. So, which basically, what do we say? 1, 2, 3, 4, 5, A, B, C. And no, A, B, C. 1, 2, 3, 4, then it would need to be a leading diagonal, which it cannot be here in a third wave. So a third wave always subdivides into an impulse wave. And if we look at the rules, I'm just gonna haphazardly throw the things out there. In an impulse wave, the fourth wave can never enter the territory of wave 1, so we cannot go down here. So that cannot be an impulse like this, yeah. And it would, in a leading diagonal, it would be possible, or in an ending diagonal. But a third wave, so always subdivides into an impulse. Yeah. Now, obviously, an impulse itself can have a leading diagonal in the first wave. So what's theoretically possible? So I'm just gonna move stuff here so to outline this. Yeah. Theoretically possible doesn't mean that we want it to, but it's possible that the impulse actually is like this: 1. Or 1 not finished yet, but then 2, 3, 4, 5. So that will make up the third wave impulse, and then the first wave of that third wave impulse would subdivide into a leading diagonal. Yeah. How do we gonna best label that? Because it's like really, yeah, the Fibonacci retracements on TradingView are garbage. So, but let's see, let's give it a try. But I think we'll just get a garbage result here. If we get a garbage result. Yeah, I don't know what's wrong with those retracement. And do we have another Fibonacci here that we can use? Fibonacci channel, Fibonacci fan wedge, time zone, pitchfork. It's a little pity. Okay, we're actually gonna try real quick something. So configure workspaces, advanced. Use this dialog to configure separate real-time. Use Google for historical. And let's see how that. There we go. Now that makes it easier to work with. Yeah. We'll have to check. So like just to make sure that our data is accurate. So in January 1987, we had a low of 40, and January 1987. Yeah, so that data is accurate here. So, and we don't have any drastic, there's a that gap here. So let's zoom in here. Obviously, I would prefer to have all the data from one data source. November 1, 2008, low 159. November 1, is that? No, that's December. November 1, low 159. Okay, it looks like now we have accurate data. So I'm actually going to clear what we have here, and we're going to move to motive wave, and we're going to do some magic. So first we're going to get a our impulse wave indicator, or not indicator, but labeling, and gonna auto label it. And surprisingly, it labels it at 1, 2. Now, if we say subdivide or decompose one level, it would say, hey, that's 1, 2, 3, 4, 5. I disagree with that, but yeah, and that would be ABC. I also disagree with that. And that would then be what it thinks is 1, 2. That actually might check out. It's pretty much similar to what I had. So to say, okay, this is only gonna be the I don't know, it still would assume that this is then wave. That this is only the impulse or the leading diagonal that makes up wave 1 of the impulse that then makes up wave 3. Yeah. Anyway, let's try to subdivide that. So let's zoom in. And then let's see what it does when we do this. It still does the same thing. So I'm not sure I would agree with that. 1, 2. But also, if we take a trend channel and use Kennedy channeling technique here, we would also, that actually would check out probably. So that would be our base channel. We have a breakout from the base channel indicating that we're in a third wave movement. We touch the top of the base channel, so we would have our acceleration channel then here, which would be 0.1 with 0.3 with a parallel through 0.2. And the moment we break through here, we indicate that we're now in fourth wave territory. We get a trend line that we put here on the top and on this top. And with the breakout here, we indicate that we're in fifth wave territory. Wave 4 then probably should obviously actually end here officially. A, B, C, 1, 2. Yeah, that will not check out. 1, 2, 3, 4, 5. Yeah, that might check out. So okay, so like this. And then we would have a destination channel. Does that one check? We can get rid of the base channel now, and we can get rid of this channel. And the destination channel would be there. There are 0.4 really matters because it defines, yeah, destination channel. Wave 5 will hit the median or the top of the destination channel. And obviously, if we put that here, it wouldn't check out. If we put that here, then suddenly, I mean, obviously, if we put that here, we also would have to adjust that line here, but it will not bring us too close. I might still check out actually. So if we then bring that down here, nope. So that might check out as basically the first 5 wave impulse pattern that we have here. Don't need that line anymore. Then from here we have what was it? Yeah, that's the right tool. From here, then we need a Fibonacci retracement that we throw here, and we can see that that's how it's supposed to look like. And then we retrace a little further than we usually would. So we have our, like usually we would expect 38.2, 50, or 61.8 retracement. We hit the 61.8 retracement, but we go a little further before we actually bounce from here. But that would, yeah, looks reasonable well to me to say, okay, this is actually wave 0, 1, and then wave 2, which means that we're now in the third wave. Now, the beauty about that is that we probably have a nice trade here. I mean, not nice or not super nice, but decent enough. Because if that's 1, 2, then wave 3 would have to eventually break out from that channel. So that big wave 3 here would need to break out from it. And in terms of profit target, if we get a Fibonacci extension and throw it here, drag it over there, then our profit target, and again, we're talking long term here, we're looking about like 30 years here or so, would be, yeah, at least here, potentially here, so we can put it here. I mean, again, we need a breakout from the channel. Yeah, time wise, yeah, like I'm not gonna say it happens next month. I'm also not gonna say it happens next year. It's just that, okay, that's what would we be aiming for, and then not the retracement, but the channel. Then we get the median of the channel. So if that would be wave 3, then wave 4 would either touch the channel again or the median of it. And then we would get a, let's drag it over here, we would get a fifth wave that recovers at least 90% of what that third wave, or what the fourth wave lost. Yeah, so that would be a potential how this should play out. The question is where we're here now. So if we now try to label this, then it says, okay, we have 1, 2, and 3, 4, blah, blah, blah. Obviously, 3, 4 would need to if that's a base channel here, so we're going to throw a channel in there again using Kennedy channeling technique. So 0.1 and 0.2, if that were indeed 0.1 and 0.2, then that would be our base channel, and we would actually need a breakout from that channel to indicate, yeah, I'm not sure if that checks out, because then our retracement might not work out very well. So yeah, like we're gonna look a little closer and try to work that one out. Based on the labeling right now, we would have a position that's really, really high risk, but even higher reward, yeah, because right now we would say, okay, if this is correct, then we're in a third wave. We would expect to at least get a new all-time high, so we need to go higher than that wave 1 to have a third wave. That's the first thing. The second thing is, two waves in an impulse are very often not identical but close to. So, and wave 3 can never be the shortest. So, like if those two happen to be close to identical, yeah, then for example we would still have. I mean, we're already late on that. We can see that we already should have been there then, which means most likely fifth wave might turn out to be identical to wave 1 or similar to wave 3 or something like that. But basically, yeah, we would already have an incredible profit target. So while our stop loss would be at 171 or 159, because only if we go lower than that is our pattern completely invalid, without confirming the lower waves right now. But our profit target would also be on the 500 mark. So while we would have 90% or 99% risk, yeah, from 63 down to almost or to less than 2, we would have also a decent potential reward. And now if we can work out this here further, it gives us a smaller stop loss, while our profit target basically remains in, yeah, like in the multiple times of what we're looking at, which is really, really nice. Yeah, now one thing we can, I mean, we're now estimating that might be a profit target. Yeah, we're actually gonna throw our Fibonacci extension real quick on the chart again, just to, yeah, so that's not the profit target here. Oh no, it actually is 3,200 would be the, yeah, like this would be a potential profit target. And now we're gonna throw a Fibonacci retracement, and oops, let's just undo that and get a new one. So we throw a Fibonacci retracement here and put it where our 0.3 would be, because if we, and I'm gonna switch to the desk cam for a second. So, and look into, if you look into where do we have ratio analysis, it was page 150 or so. If you're having the book, you can use the book to follow along. If you're reading it online, you can just use the chapters. So we're in chapter 4, ratio analysis. In the book, it's page 137. And there we can see that very often, yeah, so blah, blah, blah. Here's a generalization that subsumes some of the observations we have already made. Unless wave 1 is extended, wave 4 often subdivides the price range of an impulse wave into the golden tranche when wave 5 is not extended. So as long as we're not dealing with extended waves, we have the point that the entire impulse wave will subdivide in a way that wave 4 is either 38.2 retracement from the top, or that wave 4 is a 61.8 retracement to the top from the top. Yeah, and we also, yeah, when we deal with extensions, it looks a little bit different, because then we look at even a further movement, which would be obviously in our favor. Yeah. So that's just about the ratio stuff right now. Switching back to the desktop. Yep, there we are. And so yeah, let's figure this out. So zoom in, 2 day data. There we go. And yeah, we can. So basically saying that wave 4 would either, if it's not if this doesn't turn out to be an extended waves, wave 4 would either be likely on this price level, so we would go up and then would go down to wave 4, or it would be on this price level. Now, do we already have this price level here? So if we, can I just, no, I cannot drag that over here. So roughly around 3,200 was where we were, yeah. So no, that's 6,332, so something like there, yeah. So yeah, so wave 4 of this entire impulse would potentially, we don't have a strong movement yet. I mean, that was a strong movement, but that's likely 1, 2, 3, 4, and then 5 potentially extended. Zooming in. So which again doesn't work out as an impulse, which is so if we say Elliott wave, and that's then a leading diagonal, if we would say one either like this, yeah, and then 3, 4, and then 5 is obviously not here, but 5 would be, for example, potentially this point. Question is 1, 2, 3, 4. Yeah, I'm not sure if that checks out, but if that would be the case, then this would only be wave 1, and then we would right now, for example, could potentially be in wave 2, and wave 2 could take us down a lot, so like to here in the wave 4 territory, if this is indeed wave 4. For that, now we're at 8 days, but we need more. We need 2 days. We need more candles to work with. So, and yeah, center them. 1, 2, 3, 4, 5. I mean, that might. Let's check if it gets that pattern done. Yep. So 1, 2, but we don't have a breakout from the base channel if we were to use Kennedy channeling technique. And then here we would need to fit another impulse, and here it's probably the trickiest. No, it still would work. 1, 2, it doesn't look nice, but yeah. Okay, and then, oops, and then here, could we fit the same? Yeah, that one looks really, really ugly because wave 3 is definitely not the strongest here. Yeah, so okay, let's use another tool as aid right now here. So we're basically looking at, hey, what's going on from zooming out, not in, out, 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 from what do we have here? December 2008. So after the, yeah, like what was it? Real estate bubble. And here we go, wave basis, and we said we look at MU stock. Can we find microtechnology? Yep, there we go. And we said September. So basically we look from here, which is nice. Yeah. So yeah, you can sign up for wavebasis.com and you don't have to, yeah, if you don't sign up for their paid features, you can still use it. So if this would be, let's say 1, 2, 3, 4, and then 5 might be this. And we're just gonna enable all the smart tools. They're not always correct, especially if this is a leading diagonal instead of a impulse, because wave basis doesn't know leading diagonals. But the nice thing we get is we get additional feedback. Now the issue that I'm having here, overall, well, this part here might check out 1, 2, 3, 4, 5, which would actually make this here wave 1. And then I'm having I have trouble making this, then this would be wave 2. But then this here would be 1, 2, 3, 4, and then 5 would have not been finished yet. So actually, yeah, let's move that somewhere and move 5 somewhere. So if that's 1, 2, and then 1, 2, 3, 4, 5 theoretically would be here, but cannot be because then we have a new high. So, or yeah, so this 1, 2, 3, 4, 5 wouldn't check out because then we have a new higher set. And forgot to lock in that. And which means potentially here. And if it's here, then wave 4 should go down till here, according to the forecast. But it seems a little too little. And wave 5 would then actually, according to wave basis, be like up here. 1, 2, 3, 4, 5. That would definitely work out. And then this one here, question is with the high. So here's the high 11.4, and here we have a new high. Yeah, so this would then need to be a flat corrective pattern, but then usually we don't have a drop that's that high. So I'm gonna consult the book. So corrective patterns are really the pain in the ass of figuring everything out. So truncations, nope. That would be if we have the extended third wave, then we would have often a truncated fifth wave. That's not what we're looking for. What we're looking for is right now the rules. Double zigzag, nope, nope, nope. Flat, yeah, in a flat, we would have a flat correction differs from, so that's page 45 in the chapter 1, the broad concept. A flat correction differs from a zigzag in that the subwave sequence is 3-3-5 as shown in figures blah blah blah. Since the first actionary wave A lacks sufficient downward force to unfold into a full 5 wave, it does in a zigzag. The wave B reaction is not surprisingly seems to inherit this lack of counter trend pressure and terminates near the start of wave A. So we would have that. We don't have a lot of downward pressure, and then we terminate actually not near the start, but above, yeah. Wave C in turn just slightly, and that's the problem. Wave C usually would then terminate slightly after wave A, yeah. Now, if you recall, I mentioned very often that the corrective pattern that we have here, so that second wave very often terminates in the area of wave 4 of the previous impulse wave of a lower degree. So that 1, 2, 3, 4, 5, and then 4 would be here. And if we look, it actually terminates here, yeah. But this would indicate that wave 2 would be here, which it cannot be because we then have a new low, yeah. So, and wave 2 could theoretically be here, or it could also be here. So depending on how this pattern plays out, yeah. Then we would have, yeah, so that's what we would have. But either way, we have a new high here, which means this would need to be a flat. And if we then, let's check the rules for flats. So there's also a chapter about the rules and guidelines. We'll just have to find it. It was page guidelines of wave formation 2. And then there we are looking for the, not depth, yeah, depth of corrective waves. Yeah, blah, blah, blah. Okay, those are examples. Where was it? So we're looking at, nope, where was it? Okay, there, we're getting closer. Zigzag flat, so that would be page 89, chapter 2, guidelines of wave formation. And in a flat, we have the rules. A flat always subdivides into 3 waves. So we would need to be able to subdivide this into A, B, C. Sorry, not A, B, C, but if that's A, B, C, for example, and it ends here, then this would also need to subdivide into A, B, C, and A, B, C, and A, B, C. So always 3 waves, not 5 waves. Wave A is never a triangle. Well, that doesn't look like a triangle. Wave C is always an impulse or a diagonal, which means that would need to subdivide into a 1, 2, 3, 4, 5. Might be the case, actually. Wave B always retraces at least 90% of wave A, while we retrace more than 100% here. And that's then when we come to the guidelines, wave B usually retraces 100 to 138%, so we definitely have more than 100%. Wave C usually between 100. Wave C is usually between 100 and 165% as long as wave A, and usually ends beyond the end of wave A. Now, if we take a look, we are looking at this part here. So I'm gonna just try to hold the book open with one arm and zoom in. Wrong direction, yeah. So if we were to say that this here is wave 1, and we are now looking at, yeah, it's really, yeah, we still have a monthly chart or not, so 1 month, yeah. So let's try that as well on a monthly chart. Do we see enough data on a monthly chart so that those charts become similar enough to look at? Yep. Okay, so if we say this here would be wave 1 and this is our A, B, C, then wave C would need to, and for that we need retracement. No, not a retracement. Oh yeah, if we put it like, so that would be 1 and that would be wave A. So if we put it like this, nope. So we would need an extension actually and zoom in even more. And then we say, okay, from here to here. Yeah, do we, no, wrong point. So from here to here. And then we need to drag that onto, yeah, it's hard with the labels right now, to be honest. We need to get that onto our starting point. Can I move that with the cursors? Oh, I can, that's nice, yeah. And usually, so as said, usually then wave C would retrace between 100 and 165%. Yeah, we clearly go a little bit further than the 165, but that's only a guideline. When wave B is more than 105%, that's not the case. When wave B is more than 100%, as long as wave A and wave C does not end, okay, that we don't have. So, but technically, so technically, tools, and where's my kitty bookmark here? So we're gonna bookmark the page real quick. And correction. So technically, I said if this here is 1, 2, 3, 4, 5, then that here would be A, B, C, and as said, this here would turn out to be. Can I get the? No, it cannot. Okay, but 1, 2, 3, 4. No, and the 5 is obviously not this one. But would be this one here, and then that would turn out to be impulse wave 1, and that would be 2, and then we have 3, theoretically only either 3 is 1, 2, 3, 4, 5, so 3 is maybe here, 4 progress, 5 here. Yeah, so this way we would have a wave 1. Yeah, that works well right now, or sometimes, yeah, there we go. And then the starting point here needs to be here. Yeah, so yeah, yep, something like this. And can we, it's probably because that green dot, no, like something is not tagged right. Okay, no, it doesn't get better. Yeah, so if that's the case here, then 1, 2, 3, 4, 5, but then that cannot be the third wave, because a third wave has to subdivide into an impulse. And if we label this, it's 1, 2, 3, 4, and we clearly enter here, our high is 916 and our low here is 935. Actually, that checks out. 931. Oh, that actually works out. Interesting. Yeah, so then that would be 1, 2, 3, 4, and then not that 5, but 5 might actually, if 5 would be here, but yeah, then we would have 1, 2, 3. Yeah, it's like really hard. 5 could potentially be here as well. So what high do we have here? High we have 99, 96, and here we have a high of 98, so that's actually higher. So either we have here another ABC flat corrective pattern, or wave 5 would technically end here. I know we get a lot of patterns here, which then would make up wave 3. And then we would currently be in wave 4 territory here, where, yeah, like we would have to figure out where the fuck will wave 4 go. And for that, yeah, I don't think we'll get any better if we label this. Yeah, I would say, okay, we go down to 30. 30 would happen to align with, what do we have here? The low here, 28, which would actually indicate that, yeah, that one we probably cannot subdivide. But it can also not be like this, because if we say, okay, the third wave is here and the fourth wave ends, for example, here, so that this one here would check out better, then this would need to subdivide somehow into 1, 2, 3, 4, 5, and which only would work if our 1, 2 is below the price level that we had here. So, God, is that tricky? Okay, so okay, let's switch on to a daily chart. Zoom out, have them fixed. Can we decompose that? We can. It does it in a weird way that really probably we have problems decomposing further. But we could decompose that. I'm gonna undo that right now. Okay, if that were the case, as said, we would get better entries. So instead of having to say or better stop loss, instead of having to say, oh, we're already in overtime, sorry for going too long, yeah. So instead of having to open a trade at with a stop loss at 159, we could actually say, hey, we are waiting now. and we are potentially waiting for the $30 mark, and that's then our entry point, and our stop loss in that case would then be the $11 mark. Yeah, so here, because that would then say, hey, we cannot reach the 11. Well, actually, even right now, if we assume that 1, 2, 3 is correct, then we would say, okay, we cannot go to 1134 because that would invalidate that count. But yeah, so for this position, or for that thing, for that stock, we're not gonna enter right now, but we're gonna set a price alert, and the first price alert I'm gonna set at 35, and that's where we're gonna revisit the whole thing. And I'm just gonna take notes again. So MU, and today we have the 17th, oops, 5/17/23. We're in episode number 22. Potential drop to around 30. And then fifth wave, yeah. So again, that might not be accurate because the count here, while the initial overall count of this 1, 2 is super straightforward, even if that, yeah, like, okay, yeah, could be like this. What's the other option if the corrective wave 2 is not here, but no, it doesn't check out, so it would have to be here. And so there's no real other way. Let's get rid of the smaller labels here for now. Yeah, so then wave 4 would actually be here. If wave 2 ends here later, and that's 1, 2, then that would just be the progress of 1, 2. But that cannot be wave 3, so that would still then be, so if this would be 1, 2, and that then would be 1, 2, and then we would actually have 3, 4, 5. So there's also the chance that we go higher. Either way, so we would enter this, or we will look at it again if we go down here to the 30. So indicating, okay, that actually plays out like this, and then have an entry at 30 with a stop loss potentially at 11.34 with a take profit at 100 or higher. Yeah. Or if this part here is wrong, not saying that it's likely or unlikely, but if that turns out to be wrong, we would actually enter potentially once we have a breakout from this base channel, and then while we obviously miss out on some profit because we would enter potentially at, I don't know, can I move that? So no, not like this. We would enter potentially then, yeah, like relatively high already. So we could enter, yeah, once we go beyond 100 as well. So we already, yeah, but then it's still not confirmed that we are definitely in the third wave because we don't have the breakout from the channel. And it would have a lot of profit target left. Our stop loss would then although be harder to determine, yeah. Yeah, anyway, that's it for today. I know, like, while the overall labeling on a bigger scale here, that 1, 2 is clear and obvious, which means we should be in a third wave, which means while we still might go down or whatnot, we should not go below 159 and eventually actually reach a new all-time high. However, the risk-reward ratio, we have a huge risk, so pretty much 90% of our position, or to be precise, if we were to trade that right now and say our stop loss would be at 159, we have 79.5% risk. However, our take profit would be, as said, yeah, like, what did we have? Fibonacci extension. So our take profit would potentially be at 800 or something. So 846, and we're talking about a multi-year outlook. So yeah, we would have 100% risk with more than 1,000% reward. So it would still be a 10-to-1 in terms of risk and reward. Yeah, I'll think about it. Maybe I'll still enter a position because at the end of the day, I'm not throwing all my money into one position, but usually around 1 to 2.5% of the portfolio, which means even if we have 100% risk, at most we would risk 2.5% of the portfolio. But on the upside, if I would risk 2.5% of the portfolio, we'd also would have a potential upside of more than 25% gain. Yeah. Now that in the short run, we could lose those 2.5%, and eventually it could turn out that I'm wrong and we actually lose them permanently. In the long run, it would actually then mean, hey, we are looking at at like a 25% gain. Whereas if we only enter later, our profit target or our potential profit also would get much smaller. So I'm gonna think about this. Maybe we revisit it tomorrow as well in another episode to consider that position. And because potentially if I enter it here and it turns out that we go down to here, then we're looking at like losing 0.5% to 1% temporarily, while then in the long run, we then take advantage of that fifth wave. And we would also have the possibility that we can still double down on our position if we go down to 30 to cost average down. So I could enter that with like 1% of the portfolio. And if we go up, we still would look at like 10, 15% potential profit long term. Again, we're talking about multiple years here, as we can clearly see on the timeline. Whereas if we go down here first, we could double the position to, again, like cost average down, and then still have an overall way better potential reward. And yeah, still also our risk would still be limited to 2.5% of the portfolio at most, maybe 3% of the portfolio, depending on how much we double down, with like more than 20 to 30% potential upside. So yeah, mean that if we keep having opportunities like this, we don't have to be right that often to really, really outperform the markets. Yeah. Anyway, today we are hugely in overtime. Sorry for that. I hope you were able to take something away from this. I would encourage you, like, read the book. So there's, as I said, a link in the description that allows you to read it online for free. Open up a chart of MU yourself and then try to work out the wave pattern. I think like many of you or most of you will agree that this wave 1-2 is really, really, really obvious and clear. But I'm curious then how you guys would label that third wave and determine where we are right now. Because to be perfectly honest, I'm not fully happy with the count here, because like just from the visuals, it could also be that this is like a combination of something like A, B, C, and then with some triangle pattern playing out here, and that this is our wave 2, which then makes this part here weirder, and so on. Yeah. So yeah, like yeah. Anyway, that's it for today. Thank you all for tuning in. As always, don't forget, all the resources are linked in the description below. And don't forget to like, subscribe, and enable notifications so you get notified for the next live stream. And then, yeah, see you all tomorrow, probably with another episode of Daily Market Mastery.